3 goes on to talk about what happens if you have corporate shareholders in a corporation. So not individuals, but corporations. You'll read here that that corporations do not get the benefit of that 15% dividend tax rate. Instead, they have something called a dividend received deduction, which when a corporation receives dividends from another corporation, part or all of that dividend can be excluded from the corporation's income. You get a deduction offsetting that income of varying percents depending on how much of the corporation that the shareholder corporation owns. So you can read about that in this section and see how that impacts the overall tax calculation. What happens if earnings are retained inside the company. There's some discussion here about mitigating this double tax. Basically a tax planning or strategy session going on in these next few paragraphs. You can reduce corporate level tax sometimes by shifting income out of the corporation to one of the corporate shareholders. Maybe you can charge a wage to the corporation. That would be taxable to the shareholder, but it would be deductible to the corporation. So you'd reduce the taxable income of the corporation. There are also strategies for reducing the shareholder level tax. Remember, the double taxation impact will cause a second level of tax on the shareholder when the money is dividended out to the shareholder. Well, what if you institute a practice in the corporation of not paying dividends, of retaining earnings inside the company? This will increase the value of the company, but it won't cause a dividend payment that's taxable immediately to the shareholder. So if you delay those dividend payments, then you delay the second level of tax. And from a present value perspective, that will reduce the tax the more the dividend payment is delayed. More stuff to read here. There's limitations on number and type of owners for the different types of entities. And then there's different results when you are contributing property and services to an entity. Basically, let's say when you're starting up a company, you have an individual and you've either got money or property you're going to contribute to the entity, or you're going to contribute services to the entity in exchange for ownership rights in the entity. So in that situation, you have different results depending on what type of entity you're dealing with. So let's see. I could basically read through this entire thing. So I'm going to have you read through this information here and try and piece it together on your own and get back to me with questions. But essentially, there's a good summary right here, a good example, I should say, that has Nicole and her friend Sarah forming this company, CCS. Each one receives a 50% ownership interest in the entity. For her interest valued at 50, Nicole contributed land valued at 50 at a basis of 20. Sarah agreed to contribute services valued at 50. All right. For each interest received, 25 of the value is derived from the value of the property in the entity, and the remaining is an expectation of future profits. So what amount do they each recognize in these transactions if CCS is a corporation or an LLC taxed as a partnership? And you'll see in the summary down here, it's also discussed, but in the summary, if the entity is a corporation, Nicole has to pay tax on $30,000 of income. That's the amount of the gain, 50-50 value of the property she contributed over the basis of 20. And this is because you'll read up here that she doesn't own 80% or more of the company after it's formed. That's the big key here. With Sarah, she has to pay tax on the entire $50,000 if it's a corporation because she had nothing on day one, and then she's got an interest valued at $50,000. With an LLC, there's more flexibility here. There's a better answer usually. There's no tax to Nicole, all the gains deferred, and to Sarah, she's only got to pay tax on the $25,000 of interest that she immediately has access to, not the future profits. I'll continue in the next video.